What if ownership no longer means control? What if the assets you legally own can still be restricted, redirected, or rendered unusable without ever being taken from you? This is not a future scenario. This is already happening. Governments are not abolishing property rights. They are redefining what those rights actually allow you to do. Quietly, technically, system by system. And most people will only realize it when access is gone, but ownership remains. Ownership has always been presented as an absolute right, but in practice, it has never been independent of the system that protects it. What most people experience as private property is not a natural condition. It is a legal and institutional arrangement that functions only while the surrounding system remains stable, solvent, and capable of enforcement. This distinction matters because it reveals a truth often ignored in modern economic thinking. Ownership is not defined solely by possession. It is defined by recognition, and recognition depends on authority. Throughout history, property rights expanded and contracted in direct relation to state capacity. When governments were strong, solvent, and confident, ownership appeared absolute. When systems weakened, ownership became conditional. The illusion of permanence survived only because conditions rarely changed abruptly. In modern economies, decades of relative stability reinforced the belief that ownership was untouchable. Homes, bank deposits, securities, pensions, and businesses were treated as private by default. Legal frameworks supported this perception. Courts enforced contracts, markets provided liquidity, governments avoided overt interference. But this stability was not a permanent achievement. It was a phase. Ownership functioned smoothly because systems could afford to respect it. Debt levels were manageable. Growth absorbed shocks. Monetary credibility was intact. The cost of intervention exceeded the benefit. That balance has shifted. Ownership has always existed within limits imposed by fiscal reality. Taxes, zoning, regulation, and compulsory reporting were never optional. They were tolerated because they rarely threatened the core function of ownership. Assets could still be used, transferred, and monetized freely. The moment those functions become constrained, ownership changes character. History offers repeated examples. Land reforms during fiscal crises, capital controls during currency stress, asset freezes during conflict. In each case, ownership remained legal, but access and utility were restricted. The owner retained the title, the system retained control. This pattern is not ideological, it is mechanical. Modern legal systems were designed to balance private rights with public necessity. That balance favors private ownership only while public necessity remains limited. When necessity expands, rights contract. The defining feature of the current era is the scale of necessity. Global debt has reached levels that require constant refinancing. Governments no longer plan for repayment, they plan for sustainability. Sustainability depends on participation. Assets cannot remain fully independent in systems that require universal contribution. Private wealth becomes fiscally relevant. This is where the meaning of ownership begins to shift. In theory, ownership implies autonomy. In practice, autonomy is tolerated only when it does not undermine collective solvency. As debt grows, the tolerance for autonomy declines. Recent global events have accelerated this realization. Inflation shocks eroded purchasing power unevenly. Interest rate adjustments exposed financial fragility. Currency volatility reminded markets that value is conditional. Governments responded not by restoring old assumptions, but by expanding oversight. Bank deposits were reclassified as bail-in instruments. Pensions were adjusted through regulation. Capital markets were stabilized through intervention. None of these actions removed ownership. They redefined it. Ownership became subject to conditions. This conditionality is rarely framed as a loss of rights. It is framed as modernization, resilience, or stability. The language matters. Language determines acceptance. Most people do not notice the shift because it does not arrive as confiscation. It arrives as compliance. The modern economy relies heavily on intermediaries. Banks, custodians, brokers, platforms, and registries mediate nearly all forms of ownership. These intermediaries operate under regulatory authority. When regulation changes, ownership changes with it. The individual owner does not negotiate with the state. The intermediary does. This structure allows governments to reshape ownership indirectly. Control over intermediaries becomes control over access. Access defines utility. Utility defines value. An asset that cannot be accessed freely loses its functional meaning regardless of legal title. This is why ownership is being redefined quietly rather than challenged openly. Open confrontation damages legitimacy. Quiet adjustment preserves it. In the past, ownership was protected because systems relied on it for growth. Today, systems rely on control for stability. Growth has become secondary. This is not a moral judgment, it is a structural observation. As economies mature and debt accumulates, the priority shifts from expansion to preservation. Preservation requires coordination. Coordination limits independence. Ownership survives, but autonomy does not. This transformation is subtle but profound. It explains why assets once considered unquestionably private are now subject to oversight, reporting, and conditional access. It explains why legal ownership increasingly diverges from practical control. The distinction between owning and being allowed to use is widening. This is the foundation of the modern shift. Ownership was never absolute. It only appeared so when systems were strong enough to afford the illusion. Now, as systems strain under debt, demographic pressure, and geopolitical fragmentation, that illusion fades. What replaces it is not confiscation, but management. And management, once normalized, redefines what ownership means. The moment debt stops being temporary and becomes structural, ownership stops being private in the traditional sense. This is the central transformation reshaping modern economies, and it explains why governments are quietly redefining what ownership means without ever announcing a change in doctrine. Debt alters incentives at every level of the system. When public borrowing remains manageable, private assets can remain autonomous. When debt becomes permanent, expansive, and continuously refinanced, private assets are no longer neutral. They become part of the balance sheet of the state, whether formally acknowledged or not. Modern governments do not borrow to bridge cycles. They borrow to sustain systems. That distinction matters. Sustaining systems requires predictable participation. Tax bases must remain stable. Capital must remain accessible. Assets must remain within the jurisdictional and regulatory perimeter. In this environment, private ownership becomes fiscally relevant. Wealth is no longer merely personal, it becomes systemic capacity. This shift is not ideological, it is arithmetic. When public debt expands faster than productive growth, the state's ability to honor obligations depends on extracting value over time rather than generating it anew. That extraction does not occur through confiscation. It occurs through access, taxation, regulation, and controlled participation. Ownership adapts accordingly. Historically, debt crises were episodic. Governments defaulted, restructured, inflated, or repressed, then reset. Today's debt environment is different. It is continuous. There is no reset planned. There is only management. Management requires integration. Private assets that remain outside the system represent leakage. Leakage weakens sustainability. Weak sustainability raises borrowing costs. Rising borrowing costs threaten solvency. The feedback loop is unforgiving. This is why debt changes the rules. As sovereign obligations grow, governments must ensure that assets capable of generating liquidity, tax revenue, or financial stability remain accessible. Ownership that resists access becomes problematic. This is not about ideology or fairness. It is about system survival. Recent global developments illustrate this clearly. Rising interest rates expose the fragility of highly leveraged systems. Fiscal deficits widened even during periods of economic expansion. Emergency spending became normalized. What was once extraordinary became routine. Debt ceased to be cyclical, it became structural. In response, governments expanded oversight. Reporting requirements increased. Financial transparency was reframed as a public good. Compliance became a civic expectation. None of these measures challenged ownership explicitly. They redefined its boundaries. Ownership began to imply responsibility to the system. This responsibility manifests in many forms. Property taxes rise, capital gains rules tighten, wealth reporting expands, transaction scrutiny increases, assets remain privately held but increasingly governed. The owner retains title. The system retains leverage. This transformation is most visible in financial assets. Bank deposits, once considered sacrosanct, are now openly described as liabilities of financial institutions. During crises, they can be restricted, restructured, or converted. Legal ownership remains. Functional control shifts. The same logic applies to pensions. Retirement assets are regulated, rebalanced, and in some cases, redirected towards state objectives. Participation is mandatory. Flexibility is limited. Ownership exists within parameters. Even physical assets are not exempt. Real estate ownership increasingly intersects with zoning, environmental mandates, taxation, and usage restrictions. Property remains owned, but its utility is shaped by policy. These developments are not isolated. They are expressions of the same underlying force, debt saturation. When systems are lightly indebted, ownership can be absolute. When systems are heavily indebted, ownership becomes conditional. Conditionality allows governments to preserve legitimacy while expanding control. It avoids confrontation. It maintains the appearance of continuity. This is why the redefinition of ownership rarely sparks outrage. Nothing appears to be taken. Everything appears to be regulated. Regulation, however, accumulates. Each layer of oversight reduces autonomy. Each reporting requirement narrows discretion. Each compliance obligation integrates the asset more deeply into the system. Over time, ownership becomes inseparable from participation. This integration serves a purpose. It allows governments to mobilize private assets indirectly during stress. Taxation can be adjusted. Liquidity can be redirected. Access can be restricted temporarily, all without seizing title. Debt demands optionality. Optionality requires control. The more debt accumulates, the more optionality governments must preserve. Preserving optionality means ensuring that assets cannot exit easily. Exit is dangerous in highly indebted systems. Capital flight raises yields. Yield increases destabilize budgets. Destabilized budgets require intervention. Intervention expands control. This cycle reinforces itself. It also explains why governments increasingly focus on transparency and traceability. Visibility enables intervention. Intervention enables sustainability. Ownership without visibility undermines both. This is why anonymity declines as debt rises. Anonymous ownership limits extraction. Limits on extraction threaten solvency. The decline of anonymity is not accidental. It is structural. The result is a subtle but fundamental shift. Ownership remains, but its meaning changes. It no longer implies independence. It implies integration. This integration is often justified as fairness or efficiency. In reality, it is necessity. Highly indebted systems cannot tolerate large pools of autonomous wealth. Autonomy reduces coordination. Coordination sustains debt. This is the quiet logic driving the redefinition of ownership. It is not announced because it does not need to be. It unfolds through policy alignment, regulatory expansion, and normalized compliance. Debt does not abolish ownership. It transforms it from a right into a relationship. And relationships, once defined by systems under pressure, are rarely unconditional. Once debt reaches a certain scale, it stops being a financial variable and becomes a governing principle. At that point, economic policy is no longer about optimization. It becomes about containment. Containment reshapes every concept it touches, including ownership. Highly indebted systems cannot afford volatility. Volatility raises borrowing costs. Rising borrowing costs threaten fiscal stability. Fiscal instability forces intervention. Intervention expands control. This sequence defines modern economic governance. Private ownership is not exempt from this logic. In a low-debt environment, governments can tolerate inefficiency, hoarding, and exit. In a high-debt environment, every deviation matters. Capital that does not circulate cannot be taxed efficiently. Assets that do not participate cannot be mobilized. Wealth that remains independent weakens systemic flexibility. This is why debt transforms private assets into macroeconomic tools. The transformation does not occur through seizure. It occurs through integration. Assets are drawn into frameworks where their behavior can be influenced. Influence replaces coercion. Taxation is the most visible mechanism. Progressive structures, wealth levies, transaction taxes, and recurring property charges ensure that ownership contributes continuously. The asset remains private, but its cash flows are partially redirected. Financial regulation extends this integration. Capital adequacy rules, reporting obligations, and compliance standards shape how assets are held and used. Ownership becomes subject to policy alignment. Liquidity access is another lever. Assets that remain within regulated systems enjoy liquidity and protection. Assets outside those systems face friction. This creates a strong incentive to comply. Debt sustainability depends on predictability. Governments must anticipate where capital resides, how it moves, and when it can be accessed. Predictability requires visibility. Visibility requires disclosure. This is why transparency expands as debt grows. Disclosure transforms ownership from a private fact into a public variable. Once ownership is a variable, it can be modeled. Once modeled, it can be managed. Management allows policy to operate indirectly. Rather than seizing assets, governments adjust parameters. Tax rates shift. Reporting thresholds change. Access rules tighten or relax. The asset does not disappear. Its behavior changes. This behavioral focus is central to modern economic control. Governments are less concerned with who owns what than with how ownership affects systemic outcomes. Does the asset support liquidity? Does it generate taxable flows? Does it stabilize markets? Does it remain within jurisdiction? If the answer is yes, ownership is tolerated. If the answer is no, ownership is constrained. This conditionality explains why certain assets are favored during periods of stress. Government bonds are incentivized. Bank deposits are protected selectively. Regulated investments receive support. Independent assets receive scrutiny. The more debt accumulates, the narrower the definition of acceptable ownership becomes. This narrowing is subtle. It does not revoke rights, it layers obligations. Ownership becomes inseparable from contribution. Contribution is framed as fairness. In reality, it is solvency. Demographic pressures intensify this dynamic. Aging populations increase fiscal obligations. Healthcare and pension costs rise structurally. Future productivity cannot offset these trends easily. As a result, governments must secure existing wealth rather than rely on future growth. Securing wealth does not require confiscation. It requires ensuring that wealth remains reachable. Reachability is achieved through integration into regulated systems. This is why cash declines. This is why informal markets shrink. This is why anonymous ownership erodes. These are not moral reforms. They are fiscal necessities. Debt leaves little room for choice. At a certain point, reversing this integration becomes impossible without destabilizing the entire system. Assets have been reclassified. Expectations have adjusted. Legal frameworks have evolved. Ownership, once redefined, becomes path-dependent. Attempts to restore absolute ownership would require reducing debt materially. Reducing debt materially would require default, inflation, or radical restructuring. None of these outcomes are politically acceptable. Therefore, the system adapts ownership instead. This adaptation allows governments to preserve continuity while shifting burdens gradually. The public perceives stability. The structure absorbs pressure. From the outside, nothing appears to change. From the inside, everything has. Ownership becomes managed. Management becomes normalized. Normalization becomes permanent. This is why the redefinition of ownership is not temporary. It is structural. Debt does not merely influence policy. It redesigns the rules under which ownership exists. And once debt becomes the organizing principle of the economy, ownership stops being an absolute right and becomes a negotiated condition. Not negotiated with individuals, but with the system itself. That is the quiet transformation now underway. And it explains why governments are not abolishing ownership, but redefining what it means. The most important change in modern economies is not the redistribution of wealth, but the redistribution of control. Ownership has not disappeared. It has been functionally downgraded. What matters now is not whether an asset belongs to someone, but whether it can be used, moved, monetized, or leveraged without friction. This is the shift from ownership to access. In earlier economic systems, ownership and access were largely inseparable. If an asset was owned, it could be used freely. Physical possession implied functional autonomy. Legal recognition followed reality. Modern systems have inverted this relationship. Legal ownership can exist without meaningful access. Assets can be held on paper while their use is constrained by intermediaries, platforms, and compliance layers. This inversion did not occur accidentally. It emerged as economies became more financialized, more digitized, and more reliant on centralized infrastructure. Access is easier to regulate than ownership. Regulating ownership challenges legitimacy. Regulating access appears technical. Technical measures rarely provoke resistance. Financial assets illustrate this perfectly. Securities are owned but held in custody. Access depends on brokers, exchanges, clearinghouses, and settlement systems. Each layer introduces conditions. Trading halts, margin requirements, settlement delays, and liquidity restrictions alter access without affecting title. During periods of stress, these mechanisms activate automatically. Markets close, withdrawals are limited, transfers are delayed, ownership remains intact, function disappears. Bank deposits operate under the same logic. Depositors own their balances, but access is conditional. Withdrawal limits, transfer scrutiny, and emergency restrictions redefine what ownership means in practice. This conditional access is not an anomaly. It is design. The same logic increasingly applies to non-financial assets. Real estate ownership depends on zoning, environmental compliance, taxation, and permitted use. Property can be owned but underutilized. Usage restrictions reduce value without altering title. Even intellectual property follows this pattern. Ownership exists, but enforcement, licensing, and platform dependence shape access. Control concentrates upstream. The key insight is that modern economies no longer regulate assets directly. They regulate interfaces. Interfaces determine function. Payment systems, custodians, registries, platforms, and infrastructure nodes become the true points of control. Ownership downstream becomes symbolic if access upstream is restricted. This architecture benefits highly indebted systems. It allows rapid intervention without formal expropriation. Control can be applied selectively, temporarily, and reversibly. Reversibility is important. Measures framed as temporary rarely trigger resistance. Once normalized, they persist. Access-based control also allows differentiation. Certain actors retain access, others lose it. Ownership becomes stratified. This stratification is often justified through risk management. High net worth individuals face enhanced scrutiny. Institutions comply with stricter rules. Certain transactions require approval. Others are prohibited. Risk language replaces rights language. In a system focused on stability, risk mitigation justifies nearly any constraint. Constraints appear reasonable when framed as protection. Technology accelerates this transition. Digital infrastructure allows real-time monitoring, enforcement, and adjustment. Access can be granted or revoked instantly. Ownership becomes passive. As digital systems expand, physical autonomy shrinks. This does not require malicious intent. It requires efficiency. Centralized systems are efficient. Efficiency concentrates control. The more economies rely on centralized platforms for settlement, storage, and exchange, the easier it becomes to regulate access universally. Universal access rules replace individual property rights. This transition is reinforced by consumer preference. Convenience outweighs autonomy. Speed outweighs discretion. Most participants trade control for ease willingly. Once preferences align with infrastructure, resistance collapses. The result is a system where ownership persists legally, but access is mediated continuously. Control operates through protocols rather than force. This architecture reshapes investment behavior. Assets embedded within regulated systems gain liquidity and protection. Assets outside those systems face friction and stigma. Investors respond rationally. They favor assets with predictable access. Predictability becomes more valuable than independence. This reinforces the system. Independent assets lose relevance. Managed assets dominate. The shift from ownership to access also alters political dynamics. Governments no longer need to confront citizens directly. They work through intermediaries. Intermediaries enforce rules automatically. Responsibility diffuses. Accountability fades. When access is restricted, blame falls on systems, not policy. This reduces political cost. This is why access-based control is preferred. It preserves legitimacy. Ownership becomes a formal status rather than a functional guarantee. The implications are profound. Rights persist on paper. Power operates elsewhere. This explains why modern debates focus less on confiscation and more on regulation. Regulation controls access. Confiscation challenges ownership. Access can be withdrawn without altering ownership law. This is the modern equilibrium. As debt accumulates and systems prioritize stability, this equilibrium becomes permanent. Ownership survives as concept. Access determines reality. This is the new definition taking shape across modern economies. Not announced, not debated, but embedded. And once embedded, it becomes difficult to imagine any other way. The transition from ownership to access is no longer theoretical. It is already visible across multiple asset classes, quietly reshaping how wealth functions in practice. What unites these examples is not ideology, but infrastructure. Control has migrated to the points where access is granted, delayed, or denied. Financial markets provide the clearest illustration. Equities are legally owned by investors, yet trading access is governed by exchanges, brokers, clearinghouses, and regulators. During periods of volatility, trading halts, position limits, and margin changes alter outcomes instantly. Ownership remains intact. The ability to act disappears. This distinction became unmistakable during recent market disruptions. Investors held assets they could not sell. Prices moved without participation. Liquidity vanished selectively. The market functioned, but access was rationed. Banking systems operate on the same principle. Depositors legally own their balances, yet access is conditional. Withdrawal limits, transfer scrutiny, compliance reviews, and emergency restrictions redefine practical ownership. Funds exist on statements, but movement depends on permission. The justification is always stability. Stability legitimizes restriction. Real estate increasingly reflects this shift. Property ownership is subject to zoning, environmental regulation, usage mandates, and taxation frameworks that shape utility. Owners may hold title, but cannot freely develop, rent, modify, or sell without compliance. In extreme cases, vacancy rules, rent controls, or compulsory usage requirements redefine the economic value of ownership. Ownership persists. Autonomy does not. Pension systems illustrate the same logic. Individuals contribute to retirement accounts they technically own, yet access is restricted by age, regulation, and policy. Investment choices are limited. Rebalancing occurs automatically. In times of stress, funds may be redirected towards state priorities under the banner of prudence or protection. These constraints are rarely framed as violations. They are framed as safeguards. Digital assets further highlight the inversion. Cryptographic ownership promises autonomy, yet practical access depends on exchanges, custodians, networks, and compliance layers. Wallets can be frozen, transactions can be monitored. Platforms can deny service. Ownership exists cryptographically, but access remains mediated. The lesson is not that autonomy disappeared. It is that autonomy exists only outside systems designed for scale. Scale requires coordination. Coordination requires control. As economies scale, control migrates upward. Another accelerating factor is legal harmonization. International standards align reporting, compliance, and enforcement across jurisdictions. Assets, once movable across borders, now encounter synchronized frameworks. Exit options shrink. This harmonization reduces arbitrage. Reduced arbitrage increases policy effectiveness. Effectiveness encourages further harmonization. The cycle reinforces itself. Access-based control also allows precision. Restrictions can target specific behaviors, asset types, or actors without affecting others. Precision minimizes backlash. Backlash determines political feasibility. Governments prefer tools that minimize backlash. This preference explains why access is regulated more aggressively than ownership. Ownership challenges identity and rights. Access appears procedural. Procedural changes rarely mobilize resistance. Technology enables real-time enforcement. Access can be modified instantly, globally, and selectively. No physical presence is required. No confrontation occurs. This technological capability fundamentally alters power dynamics. Control becomes embedded in systems rather than asserted through force. Once embedded, it becomes invisible. The most consequential effect of this shift is behavioral adaptation. Investors adjust expectations. Households prioritize convenience. Institutions align with frameworks. Independent ownership becomes niche. Niche assets attract less political protection. Less protection makes further restriction easier. This is how access replaces ownership without debate. The system does not need to convince individuals that ownership is obsolete. It needs only to make access the default interface. Once interfaces change, behavior follows. This process accelerates during periods of stress. Crises justify intervention. Intervention normalizes control. Normalization persists after crises fade. Over time, access-based governance becomes standard practice. The implications extend beyond finance. Healthcare, education, transportation, and energy increasingly operate on access models. Subscription replaces possession. Usage replaces ownership. Economic culture shifts accordingly. Ownership becomes symbolic. Access becomes practical. This cultural shift reinforces policy objectives. When people expect access rather than autonomy, restrictions feel less intrusive. The boundary between private and public blurs. What emerges is a managed economy where ownership exists, but only within predefined channels. Channels determine outcomes. In such an environment, independence is not illegal, it is impractical. The modern economy does not abolish ownership, it redefines its relevance. Access becomes the real currency of power. Those who control access shape outcomes. Those who merely own adapt. This is the structural reality now taking hold, not announced, not voted on, but implemented through design. And once design replaces law as the primary mechanism of control, reversing the process becomes extraordinarily difficult. Ownership survives as language. Access governs reality. That is the world modern economies are building, quietly and deliberately. The redefinition of ownership does not occur through ideology. It occurs through tools. Modern governments rarely challenge property rights directly because direct confrontation carries political cost. Instead, they redesign the mechanisms through which ownership operates. Control is achieved not by taking assets, but by shaping how those assets can be used. The most important of these tools is regulation. Regulation does not remove ownership, it qualifies it. Each new rule introduces conditions that narrow autonomy while preserving legality. Over time, conditions accumulate, autonomy erodes. Regulation works because it appears neutral. It is framed as technical necessity, consumer protection, financial stability, or environmental responsibility. Each justification is defensible in isolation. Together, they reshape the entire concept of ownership. Financial regulation illustrates this clearly. Capital requirements, reporting obligations, transaction monitoring, and compliance standards do not question who owns assets. They dictate how assets must behave. Behavior becomes policy compliant by design. As regulatory complexity increases, ownership requires professional mediation. Lawyers, custodians, accountants, compliance officers, and platforms become necessary intermediaries. Each intermediary operates under regulatory authority. Control migrates upstream. This migration matters. When intermediaries control access, governments control intermediaries. Ownership downstream becomes dependent. Taxation is the second critical tool. Taxes no longer serve only to fund government. They serve to guide behavior. Recurrent property taxes, wealth assessments, transaction levies, and capital gains frameworks ensure that ownership produces continuous contribution. Contribution becomes expectation. The distinction between owning and contributing blurs. Assets that fail to contribute adequately are penalized through higher rates, additional scrutiny, or reduced benefits. Ownership remains legal. Utility declines. This approach allows governments to extract value without expropriation. It preserves legitimacy while ensuring participation. Emergency powers represent the third tool. Modern legal systems grant governments expansive authority during periods of financial instability, national security risk, or systemic stress. These powers are intentionally broad and flexible. Flexibility enables discretion. Emergency measures are rarely introduced as permanent. They are framed as temporary safeguards. History shows that temporary measures often persist. Once normalized, they become baseline governance. Emergency powers matter because they override normal constraints. They allow rapid modification of access, movement, and use of assets. Ownership survives. Control intensifies. Another essential tool is surveillance. Transparency requirements expand continuously. Financial flows, asset ownership, and transactions become increasingly visible. Visibility transforms ownership into data. Data enables modeling. Modeling enables intervention. When ownership becomes legible, it becomes governable. Governance does not require seizure, it requires adjustment. Surveillance also changes behavior preemptively. When individuals know that actions are monitored, they self-regulate. Self-regulation reduces enforcement costs. Systems prefer self-regulation. The expansion of surveillance is justified as efficiency, security, and fairness. Resistance is framed as suspicious. The social cost of dissent rises. Compliance becomes cultural. Legal harmonization amplifies these tools. International standards align reporting, taxation, and compliance frameworks. Jurisdictional differences shrink. Mobility declines. Assets encounter similar rules regardless of location. This harmonization reduces exit options. Reduced exit increases control. Another powerful tool is platform dependence. Digital platforms mediate access to markets, payments, storage, and exchange. Platforms enforce rules automatically. Users accept terms to participate. Terms replace law. When platforms change rules, ownership adapts instantly. Appeals are limited. Enforcement is automated. Accountability diffuses. Platform governance allows granular control. Access can be restricted selectively, temporarily, or conditionally. Ownership remains intact. Function varies. This variability is central to modern control. It allows systems to respond dynamically without altering legal frameworks. Narrative control complements these tools. Ownership restrictions are framed as modernization, resilience, or alignment with global standards. The language avoids conflict. It emphasizes necessity. Narratives matter because they shape perception. Perception determines acceptance. Most individuals do not resist gradual change. They resist abrupt loss. Gradualism avoids backlash. This is why modern control operates incrementally. Each step appears reasonable. The cumulative effect is transformative. Another subtle tool is incentive alignment. Governments subsidize compliant behavior. Tax advantages favor certain assets. Guarantees protect regulated investments. Non-compliant assets receive no support. Rational actors respond to incentives. Over time, ownership choices converge toward policy objectives. Autonomy becomes inefficient. This convergence reduces the need for enforcement. The system shapes outcomes automatically. The final tool is legal ambiguity. Laws are written broadly. Interpretation evolves. Enforcement discretion expands. Ambiguity allows flexibility. Flexibility allows adaptation without legislative overhaul. This is how ownership is reshaped without debate. Each tool alone appears benign. Together, they redefine ownership as conditional participation. Conditional participation satisfies systemic needs. It allows debt management, fiscal extraction, and stability preservation. The public perceives continuity. Legal titles remain. Markets function. The shift goes unnoticed. But the meaning has changed. Ownership no longer guarantees control. Control depends on alignment. Alignment depends on compliance. Compliance depends on system stability. This is the architecture of modern ownership. It is not imposed suddenly. It is constructed quietly. And once constructed, it becomes the default environment in which all ownership exists. The tools do not disappear when crises end. They become infrastructure. Infrastructure defines reality. This is why the redefinition of ownership feels invisible. It is embedded in how systems operate, not as an exception, but as a standard. The tools of modern control are not theoretical constructs. They are already deployed across advanced economies, quietly reshaping ownership through precedent rather than proclamation. What makes them effective is not their severity, but their normalization. One of the clearest examples is the banking system. Bank deposits are legally owned by customers, yet functionally governed by regulatory frameworks that prioritize systemic stability. During periods of stress, withdrawals can be limited, transfers delayed, and access conditioned. These measures are justified as protective. Ownership remains intact. Utility is temporarily suspended. Temporary suspensions, however, establish precedent. Once applied, they redefine expectations. Depositors learn that access is contingent. Contingency alters behavior. Capital controls provide another illustration. Historically associated with developing economies, they are now reintroduced quietly in advanced systems under different language. Reporting requirements, transfer thresholds, approval processes, and compliance checks restrict movement without formal prohibition. Capital remains owned. Mobility declines. Real estate policy further demonstrates the shift. In multiple jurisdictions, property owners face increasing restrictions on usage, development, rental terms, and occupancy. Environmental mandates, zoning revisions, vacancy penalties, and rent regulations redefine economic value. Ownership survives legally. Economic autonomy contracts. These measures are framed as social responsibility, housing affordability, environmental protection, urban planning. Each justification resonates publicly. Few recognize the cumulative effect on ownership. Pension systems reveal a similar pattern. Retirement assets are nominally owned by individuals, yet governed by strict rules on contribution, withdrawal, and allocation. In times of stress, investment mandates shift toward government securities or systemically favored assets. The rationale is safety. The effect is mobilization of private savings. This mobilization is rarely optional. Tax policy increasingly operates as behavioral enforcement. Wealth reporting regimes expand. Asset disclosure becomes routine. Compliance costs rise. Taxation discourages certain forms of ownership while rewarding others. The system guides capital without confiscation. Digital finance accelerates this process. Payment systems, digital wallets, and financial platforms embed compliance into architecture. Transactions can be monitored, flagged, delayed, or blocked automatically. Ownership exists digitally, but access depends on platform rules aligned with regulation. Platform dependence concentrates control. Few intermediaries handle most transactions. When intermediaries comply, enforcement scales instantly. This architecture allows selective restriction. Access can be limited for specific users, asset classes, or behaviors without broad measures. Selectivity minimizes resistance. Geopolitical developments reinforce this trajectory. Asset freezes, sanctions, and jurisdictional enforcement demonstrate that ownership is conditional on alignment. These actions normalize exceptional measures. Once normalized, their use expands beyond initial targets. The psychological impact is significant. Investors adjust assumptions. They prioritize compliance over independence. Assets embedded within regulated systems gain preference. Independent assets lose liquidity and legitimacy. This adaptation is rational. Markets reward predictability. Predictability requires alignment. Another important example is environmental regulation. Climate mandates increasingly affect asset usage and valuation. Carbon reporting, usage limits, and compliance costs reshape ownership economics. Assets remain owned, but their function is regulated. Environmental justification provides moral legitimacy. Moral legitimacy lowers resistance. The same dynamic applies to health and safety regulation, consumer protection, and digital governance. Each domain introduces rules that reshape how assets are used. Ownership remains secondary. What unites these examples is not ideology, but scalability. These tools scale efficiently. They operate through systems rather than enforcement actions. They persist beyond crises. Persistence is critical. Once controls are embedded, removing them appears risky. Stability becomes dependent on them. This is why reversals are rare. The system adapts to the new normal. Legal frameworks adjust. Expectations recalibrate. Ownership becomes contextual. Rights exist, but are exercised within evolving constraints. The future trajectory is clear. As debt pressures persist and systems prioritize stability, reliance on these tools will deepen. More assets will be integrated. More access points will be regulated. More ownership will become conditional. This does not signal authoritarian shift. It signals administrative expansion. Administration replaces coercion. The distinction matters because administrative control attracts little resistance. It appears neutral. It appears technical. It appears necessary. The redefinition of ownership is therefore not a future event. It is an ongoing process. Each year, new rules are added. Few are removed. The cumulative effect reshapes reality. Ownership survives as a legal concept. Control governs its expression. This is the modern equilibrium. Not imposed suddenly, not debated openly, but implemented through practice. And because it operates through systems rather than decrees, it becomes difficult to challenge. This is how ownership is redefined without ever being taken away, quietly. The redefinition of ownership is not an abstract policy trend. It is a strategic response to structural constraints that are unlikely to disappear. Understanding what ownership will mean going forward requires abandoning old assumptions and accepting a new operating environment shaped by debt, demographics, and permanent intervention. The future of ownership will not be defined by legality, but by usability. Legal title will remain important, but insufficient. What matters increasingly is whether an asset can be accessed, transferred, monetized, or leveraged under stress. Stress is no longer an exception. It is the baseline condition of modern economies. Highly indebted systems cannot return to neutrality. They must actively manage outcomes. Active management requires predictable behavior from assets and asset holders. Ownership that resists predictability becomes a problem to be solved rather than a right to be protected. This is why the concept of safe assets is evolving. Safety no longer means independence, it means alignment. Assets considered safe are those embedded within the system, visible to authorities, and responsive to policy signals. Government bonds, regulated deposits, and approved financial instruments benefit from protection precisely because they are controllable. Their safety derives from integration, not autonomy. Independent assets, by contrast, face a trade-off. They may preserve value, but lose institutional support. Liquidity becomes conditional. Access becomes uncertain. Their protective function weakens when most needed. This trade-off forces adaptation. Investors, institutions, and households increasingly adjust portfolios toward assets that balance preservation with permission. Absolute independence becomes less attractive when it carries operational risk. Conditional access becomes acceptable when it offers predictability. This behavioral shift reinforces the system. As more capital aligns, the cost of independence rises. Independent ownership becomes niche. Niche assets receive less political defense. Less defense invites further restriction. This feedback loop is self-reinforcing. The future of ownership will therefore be stratified. Some assets will remain broadly usable, liquid, and protected because they support systemic objectives. Others will remain legal but constrained, functioning as long-term stores rather than active tools. Ownership becomes contextual. Context matters more than principle. Another defining feature of future ownership is conditional reversibility. Access can be expanded or restricted depending on circumstances. During stability, constraints relax. During stress, they tighten. This elasticity allows systems to respond dynamically. Elastic ownership favors authorities. It reduces the need for permanent confiscation. Temporary measures achieve similar outcomes without long-term legitimacy costs. Over time, temporary becomes normal. This elasticity will be embedded into legal and technical frameworks. Smart regulation, digital infrastructure, and automated compliance systems enable rapid adjustment. Ownership conditions can change without legislative action. This capability represents a fundamental shift. In the past, ownership rules were static. Today, they are adaptive. Adaptive rules favor systems under pressure. Global coordination accelerates this evolution. As regulatory frameworks converge, ownership conditions harmonize across borders. Geographic diversification offers diminishing protection. Jurisdictional arbitrage narrows. This does not eliminate options, but it reduces them. At the same time, narrative alignment plays a crucial role. Ownership is increasingly framed as responsibility. Wealth carries obligations. Assets are expected to contribute to social and fiscal objectives. This framing alters expectations. Resistance appears selfish. Compliance appears civic. Narratives matter because they determine legitimacy. Legitimacy determines sustainability. The future owner is not defined by autonomy, but by participation. Participation is rewarded. Non-participation is tolerated only at the margins. This shift is particularly relevant for long-term investors. Strategies built on absolute control must adapt to managed environments. Risk assessment must include political, regulatory, and access dimensions. Return is no longer the sole metric. Usability under stress becomes equally important. This changes portfolio construction fundamentally. Diversification across asset classes is insufficient if all classes depend on the same access points. True diversification requires understanding infrastructure dependencies. Who grants access? Under what conditions? And how quickly those conditions can change. Ownership without clarity on these questions is incomplete. Another implication concerns intergenerational wealth. Assets passed down may retain legal title but face evolving conditions. What was usable for one generation may be constrained for the next. Long-term planning must account for this evolution. The concept of buy and hold forever loses meaning when holding conditions change. Flexibility becomes essential. This does not imply pessimism, it implies realism. Managed economies are not collapsing economies. They are adapting to constraints. Ownership adapts with them. Those who recognize this early can adjust strategies accordingly. Those who cling to outdated assumptions face unexpected friction. The future of ownership is therefore not about loss, but about transformation. Ownership survives. Control is shared. Access is conditional. Understanding this allows rational decision-making. Ignoring it invites surprise. This is the final lesson of the redefinition underway. Ownership is no longer a static right anchored in law alone. It is a dynamic relationship between asset holders and systems managing stability. As systems face persistent pressure, that relationship becomes more structured, more visible, and more conditional. What ownership means going forward is not defined by ideology or conspiracy. It is defined by arithmetic, incentives, and infrastructure. Debt demands coordination. Coordination demands control. Control reshapes ownership. This is the environment in which future wealth will exist, not confiscated, not abolished, but managed. Quietly. What ultimately emerges from this transformation is not the end of ownership, but the end of ownership as a shield. In previous eras, owning assets created distance from the state. Today, ownership increasingly creates proximity. This is the fundamental inversion. Assets once protected individuals from systemic risk. Now, they connect individuals to it. The larger the asset base, the deeper the integration. Wealth no longer exists outside the system. It exists within it. This reality alters power relationships permanently. When ownership becomes embedded, leverage shifts upward. Systems gain flexibility. Individuals gain responsibility without control. The balance changes quietly, but decisively. The most important consequence is irreversibility. Once ownership is redesigned to function through access, intermediaries, and compliance layers, restoring absolute autonomy would require dismantling infrastructure itself. That would mean destabilizing payments, markets, and governance. No modern state will choose that path voluntarily. Reversal is therefore not a policy option. Adaptation is. This is why debates about whether governments will redefine ownership are already outdated. They have. The remaining question is how far and how fast the process will continue. The answer depends on pressure. Debt pressure does not fade. Demographic pressure intensifies. Geopolitical fragmentation increases volatility. Climate and technological transitions add further strain. Each force pushes systems toward more coordination, not less. Coordination requires visibility. Visibility requires control. Control reshapes ownership. This chain does not break. Another consequence is normalization across generations. Younger participants enter systems where conditional access is standard. They do not experience loss. They experience default settings. What older generations perceive as erosion, younger ones perceive as structure. This generational reset matters. It removes political friction. Change becomes cultural rather than legislative. Over time, the language of ownership adapts. Terms like rights fade. Terms like permissions, compliance, and eligibility dominate. Legal frameworks follow language. What cannot be named clearly cannot be defended easily. This linguistic shift further entrenches the new model. At the same time, inequality changes character. It is no longer defined purely by asset quantity, but by access quality. Two individuals may own similar assets, but experience radically different outcomes depending on their integration level. Access becomes the real divider. Those closer to policy centers, institutions, and compliance structures retain flexibility. Those outside experience friction. Ownership alone does not equal influence. This creates a new elite, not owners, but access holders. Access holders navigate systems smoothly. They anticipate restrictions. They align early. They rarely confront constraints directly. The rest adapt late. From a strategic perspective, this environment rewards awareness rather than resistance. Fighting the system head-on carries cost. Understanding its mechanics creates optionality. The rational response is not withdrawal, but calibration. Calibration means recognizing which assets benefit from integration and which preserve optionality. It means understanding where access points exist and how they behave under stress. It means assuming that rules will change and preparing accordingly. This is not pessimism, it is realism. The modern economy is not built to maximize freedom. It is built to preserve stability under strain. Ownership is reshaped to serve that objective. Those who expect absolute autonomy will be disappointed. Those who adapt will retain agency. Agency no longer comes from isolation. It comes from navigation. This is the final transformation. Ownership is no longer about standing apart. It is about positioning within. Positioning determines outcomes, and positioning requires clarity. Clarity about incentives, clarity about power, clarity about how systems actually work. The redefinition of ownership is therefore not a warning. It is a description of the world as it is becoming, quietly, structurally, irreversibly. Those who understand it early retain choice. Those who ignore it lose it gradually. Not through confiscation, not through collapse, but through design. That is what governments are redefining when they redefine ownership. And that is the environment in which the next generation of wealth will exist. This is not about fear. It is about understanding the rules of the system you are already inside. The greatest risk today is not confiscation. It is assumption. Assuming that ownership still protects you. Assuming that access is guaranteed. Assuming that past rules will apply in a system built on debt, control, and stability at all costs. If you want to understand how power really works in the modern economy, who controls access, and how wealth is being quietly redesigned, then stay here. Because the future of ownership will not be decided in headlines. It will be decided in systems. And those who understand the system early retain choice. Those who don't lose it without ever being told it was taken.